Mortgage rates, Fed fund rates, and what does it mean to you? Lately, I have had several people ask me about mortgage rates and what I think is going to happen to them. Believe me, when the Feds move interest rate, mortgage rates change too. Let me explain how, why, and what happens to you when they do. For those of you who do not know me, my name is Mike Lavoie. I am a realtor with Dalton Wade Real Estate here in the beautiful Tampa Bay area. My wife Paula and I love working with both home buyers and home sellers throughout the entire Tampa area. If this is your first time to our favorite YouTube channel, go ahead and click on the subscribe button down below and hit that notification bell as well. We will send you a message when our next video is published. A discussion about mortgage rates is just about as riveting as watching grass grow.
Come on. Hey, Peter. Hey, Joe. Damn it!
So I am going to try to keep it interesting and get you some solid information. First, let me say right up front, I am not a mortgage broker. I am a realtor. If you want specific information about a mortgage or information about your mortgage application, contact your licensed mortgage broker. If you would like me to send you some contact information on a couple of brokers we use, send me an email, give me a call. I will be happy to get that information out to you. I have a couple of charts to show you, and that will be it for the boring part. The first chart is from Freddie Mac's website showing the average monthly interest rate from 1971 through March 12 of 2020. Looking at the chart, it's interesting only when you look at it at a historical basis compared to current rates. Back in the early 80s, people were paying 15 to more than 16% a year for mortgage. I was one of those people. I purchased my first home in 1982 and was paying over 16% and thought it was great. Since that time, rates have bounced around a lot, but overall they've come down quite a bit. Since the housing and stock market crash of 2007 and 8, rates have hovered around 3.5% to 5% range. Why? Because of that market crash. The Federal Reserve reduced the Fed fund rate to historical lows, pretty much near zero, to help stimulate the economy. Since then, the Fed has kept the Fed fund rate at historical lows. Fed fund rate? Go ahead, ask, what the heck is that? Simply put, the Fed fund rate is the interest rate charged for overnight loans between banks. Those loans make sure the banks meet their minimum funding requirements. Great, but how does that affect my mortgage rate? Well, directly it doesn't really. However, indirectly, when the Feds move the overnight rate either up or down, the banks pass those costs on to the consumer in several different ways. One of those is in the mortgage rates charged by the banks or your lender. The 30-year fixed-rate mortgage, which is kind of the benchmark for all mortgage rates, was at an all-time low in mid-March of 2020, and it stood at 3.29%. Do not kick yourself for not locking in that rate. Rates change, it seems like every 10 minutes. If you would like a current quote, contact a licensed mortgage broker. So in my opinion, and it's only my opinion, rates will probably remain low for a while yet. My guess is that after the election, the Fed will start raising the rates slowly over the next year or so. They need to get some cushion in the rates to be able to move around a little bit in case we have an economic issue. And if they keep the rates where they are right now, which is close to zero, there is no room for any kind of rate change. Let's talk about affordability for a minute. The Fed fund rate and its effect on mortgage rates tells you, the consumer, how much you can afford for a mortgage. Normally, your mortgage is made up of more than what you might think. Most of the time, the amount you send to the lender or the processor consists of principal, interest, tax, and insurance. Some payments also include PMI, which I go over in a different video. The common acronym is PITI, and it goes by the nickname of PITI. Of that, insurance and taxes vary on the size of the house and where you live. For example, if you live close to the water, like a lake or an ocean, you're going to have a higher premium for homeowners insurance. Taxes also vary depending on the size and the location of the house. So principal and interest are pretty much a standard calculation. When I talk about mortgage payments here, I am referring to the principal and interest amounts only. What I want to touch base on is how interest rates change your affordability. One more disclaimer, other than that I am not a licensed mortgage broker, is that the calculations I'm going to show you were worked up on a standard financial calculator. It's my HP 12C that I purchased in 1986, I think it was. You can do the same calculations on many of the popular home search websites, like the one that starts with a Z, but whose name should not be said.
And who owned that wand?
We do not speak his name. Voldemort.
Voldemort.
Lord Voldemort.
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 Voldemort. Voldemort. Voldemort. Voldemort. Voldemort. Voldemort.
Let's assume, for the sake of argument, you're applying for a $500,000 loan on a 30-year fixed-rate mortgage. If you had been so lucky to get the best rate in history so far at 3.29%, your principal and interest payment would be about $2,100 a month. If you wait until rates go up and you lock in at 3.75%, your monthly payment would be about $2,300. That's an increase of $128 or 6% a month. That works out to $1,536 a year for 30 years. It's just about $46,000 over the term of the loan, all because of less than 0.5% increase in mortgage rates. If mortgage rates get back to where they were earlier this year, like say 4.25%, your monthly payment would be about $2,500, which is an increase of $272, and that works out to about $100,000 for the term of the mortgage. Affordability comes into play when you apply for the loan. At 3.29%, your monthly income would have to be at least $6,200 to qualify for that $500,000 loan. At 4.25%, the minimum monthly income you would need to be is at about $7,000 to be able to afford that same mortgage. That is the affordability factor. The question is now a good time to buy a home? And really, the answer is a couple more questions. One, do you need a home? Do you need something bigger, something smaller, maybe something on the beach? Are you currently renting? Do you have stable employment? You're going to need to apply for a mortgage. For more information on applying for a loan, watch this video. Are you planning on living in the home for more than 4 or 5 years? That is about the length of time it will take to recoup the cost of buying the home and come out a little bit ahead. If you're renting, current mortgage rates make ownership much better looking than ever before. Rent on a $300,000 home is going to be close to $2,500 a month. It might make more sense to own, get the equity benefit of paying off your mortgage, not your landlord's. If the answer to any of these questions is yes, maybe you should be looking for a home. Team up with an outstanding realtor, it just so happens I know one, and get a great mortgage broker. Do your research. Don't let a great opportunity like the current mortgage rates get away from you. They are at historic lows and they will not stay there for long. If you'd like more information on buying a home, watch these videos. If this is your first time at our channel, go ahead and click on the subscribe button down below, hit that notification bell, and we will send you a note the next time we have a video come out. If you thought the film was good, go ahead and give it the old thumbs up down there too while you're at it.